In September 2008, the United States stood at the edge of total economic collapse, and every banker on Wall Street could feel it coming. The decision made inside the Federal Reserve Building in Washington, D.C., that week would send consequences rippling into financial markets for nearly 2 decades. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. Picture Wall Street on September 15, 2008, with traders standing frozen in front of bright red screens inside the New York Stock Exchange. Lehman Brothers, one of the most powerful investment banks in American history, filed for bankruptcy on that single morning without warning. The Lehman Brothers building at 745 7th Avenue in New York City went silent as employees carried cardboard boxes out through revolving glass doors. Within hours, financial markets across London, Tokyo, and Frankfurt began falling simultaneously like dominoes, arranged carefully across a very long table. Credit markets, the invisible arteries that carry money through the global economy, seized up and stopped flowing in any direction at all. Banks across New York City stopped lending to each other because every institution feared the hidden losses sitting on every rival balance sheet. Ordinary people across America walked up to ATM machines on street corners and wondered quietly whether their savings would still be there. The Federal Reserve Building in Washington, D.C. became the most urgently watched address on the entire planet during those first 72 hours. Inside that building, a quiet economist named Ben Bernanke was reading history in real time and calculating how quickly he needed to act. Bernanke had spent his academic career at Princeton University studying the Great Depression of the 1930s, and he recognized every signal in front of him. He understood that, in 1929, the Federal Reserve had made a catastrophic mistake by tightening money supply at the worst imaginable moment. That single policy error in 1929 had turned a severe recession into a 10-year disaster that destroyed millions of lives across the world. Bernanke refused to let history repeat, and he began moving with a speed that startled even his closest and most experienced colleagues at the Fed. The Federal Reserve started cutting interest rates aggressively, dropping them from 5.25% in 2007 down toward 0 by December 2008, when cutting rates alone proved insufficient. The Federal Reserve launched a program unlike anything the financial world had witnessed at this enormous scale. They named it Quantitative Easing, and while the phrase sounded technical, what it described in plain terms was genuinely extraordinary. The Federal Reserve began creating new money electronically and using those funds to purchase government bonds and mortgage-backed securities from banks. In simple language, the Central Bank of the United States was generating money and injecting it directly into the veins of the financial system. Between 2008 and 2014, the Federal Reserve expanded its balance sheet from roughly $900 billion to over $4.5 trillion total. Imagine filling the floor of the New York Stock Exchange with stacked dollar bills reaching 10 feet high, and that picture begins to capture the scale. Congress also moved rapidly, passing the Troubled Asset Relief Program, which authorized $700 billion to stabilize failing financial institutions across America. Treasury Secretary Henry Paulson stood before television cameras in Washington, D.C., and told a frightened nation that the banking system had to be saved. Major institutions, including Citigroup, Bank of America, and J.P. Morgan Chase, received billions in government funds to keep their branch doors open. The public argument was plain. If these large banks failed, the entire economy would collapse alongside them, and ordinary workers would suffer the most. Critics across the political spectrum called it a rescue of wealthy shareholders funded at the direct expense of working-class American families. But in the short term, the strategy appeared to work, and the immediate financial freefall stopped before it became a total, unstoppable economic collapse. By March 2009, stock markets reached their lowest point, and then, slowly at first, they began climbing back upward with growing momentum. The Dow Jones Industrial Average, which had fallen below 6,500 points in 2009, began what would become one of the longest bull runs in history. By 2013, markets had recovered all their losses, and by 2020, the major American stock indexes had more than tripled from those desperate 2009 lows. The medicine appeared to have worked, and economists in Washington, D.C. and London celebrated what they called a successful and historic policy intervention. But deep inside the mechanics of that recovery, a second and quieter story was developing that would take many years to fully reveal itself. When interest rates fall toward 0, the cost of borrowing money becomes almost nothing for governments, corporations, and large institutional investors worldwide. Corporations across America began borrowing at record low rates, not to build new factories or hire additional workers, but for something very different. They used that borrowed money to buy back their own shares on the open stock market, a financial maneuver called a stock buyback. Between 2009 and 2019, American corporations spent over $5 trillion repurchasing their own stock using cheap borrowed money from eager lenders. Each buyback reduced the number of shares available in the market and mechanically pushed the price of remaining shares reliably higher over time. Executive pay packages tied directly to rising share price meant the people making these buyback decisions personally benefited from enormous financial gains. Meanwhile, workers whose income came from wages rather than stock portfolios saw far smaller gains during that same decade of supposed economic recovery. The Federal Reserve in Washington, D.C. had effectively become a mechanism that inflated the price of assets held primarily by the already wealthy. Anyone who owned a home, a stock portfolio, or a business saw their net worth grow meaningfully across the decade that followed. 2008, anyone who rented an apartment, carried student loan debt, or relied entirely on wages saw their financial position stay flat or deteriorate. This expanding gap between asset owners and wage earners became one of the defining economic tensions and political flashpoints of the entire 2010s. Real estate prices in cities like San Francisco, New York, London, and Sydney climbed far beyond what average household wages could realistically support. Young workers in their 20s and 30s found themselves priced out of the same housing markets their parents had entered with relative ease. The Federal Reserve held interest rates near 0 for 7 full consecutive years between 2008 and 2015, an unprecedented stretch in American financial history. When rates finally rose, they moved slowly, like someone walking across a frozen lake in winter, careful not to crack the fragile ice beneath. Corporations and governments had grown so deeply dependent on cheap money that any meaningful rate increase threatened immediate and serious economic pain. The entire global economic structure had been rebuilt on a foundation of near zero interest rates, and that foundation was not easily replaced. Government debt across the developed world expanded dramatically as borrowing remained cheap and political pressure to keep spending high never eased. The United States federal debt stood at approximately $10 trillion when the 2008 financial crisis first began its path of destruction. By 2020, that same debt number had grown to $27 trillion, driven by stimulus programs, tax cuts, overseas conflicts, and low borrowing costs. Japan, the European Union member states, and the United Kingdom followed the same path, each accumulating national debt at historically unprecedented levels. The logic seemed sound at the time. Borrow cheap money today, grow the economy, and repay the debt using future tax revenue from that growth. But that logic contained a hidden assumption that interest rates would stay low long enough for economic growth to actually deliver on its promise. It resembled a family taking an adjustable rate mortgage and assuming their household income would grow fast enough before the payments adjusted upward. In early 2020, something entirely unexpected arrived and shattered every economic model, every projection, and every assumption that global policymakers had been relying on. A worldwide pandemic forced governments across 6 continents to shut down large portions of their economies almost simultaneously, with almost no preparation time. The United States Congress passed the CARES Act in March 2020, authorizing approximately $2.2 trillion in emergency relief to prevent economic freefall. Direct checks were delivered to American households, expanded unemployment payments flowed through the banking system, and businesses received government-backed forgivable loans. The Federal Reserve responded with asset purchases larger and faster than anything attempted during even the 2008 crisis, moving with extraordinary urgency. Between March and June 2020, the Federal Reserve expanded its balance sheet by $3 trillion in only 90 days of emergency action. Global central banks together injected an estimated $9 trillion into financial markets during the first 12 months of the pandemic response period. Supply chains, the vast networks of factories, container ships, busy ports, and freight trucks were severely disrupted across every major continent at once. Factories in Vietnam, China, and Mexico closed or cut production sharply, while consumer demand from households receiving stimulus checks surged in the opposite direction. The result was simple economics playing out at global scale. Too much money chasing too few goods causes prices to rise across entire economies. By mid-2021, inflation was accelerating across America and Europe at rates not seen since the oil shock era of the early 1980s. The Consumer Price Index in the United States hit 9.1% in June 2022, the highest reading recorded in more than 40 years of data. Grocery stores across American cities displayed higher price tags on everyday items that families had purchased at stable prices for many previous years. Gasoline stations showed numbers that felt shocking to drivers who had always considered fuel a basic and reliably affordable part of daily life. The Federal Reserve, which had spent 14 years holding rates near zero, was now facing a completely different and deeply urgent problem. The same institution that had flooded the system with money to prevent deflation was now confronting the dangerous consequences of too much inflation instead. In March 2022, the Federal Reserve began raising interest rates at the fastest pace recorded since the inflation-fighting era of the early 1980s. Within 12 months, the benchmark interest rate rose from near zero to over 4%, a move of genuinely historic proportions and speed. Every corporation, every government, and every household that had borrowed heavily during the low-rate era suddenly faced sharply higher costs on that debt. Commercial real estate buildings across New York City, Chicago, and Los Angeles saw property values begin falling as financing costs made development deals unworkable. Office towers financed with cheap short-term loans during the zero-rate era now faced refinancing at rates 2 to 3 times higher than before. Regional banks holding large portfolios of commercial real estate loans began showing visible strain, echoing sounds that felt uncomfortably familiar to careful observers. Silicon Valley Bank collapsed in March 2023, a failure that sent shockwaves through the technology sector and the regional banking industry at once. The bank had loaded its balance sheet with long-duration government bonds during the low-rate era, and those bonds lost significant value as rates rose. This was not isolated recklessness, but a direct consequence of incentive structures built during 14 years of extraordinarily cheap and easily available money. The solution applied in 2008 had created the very conditions that made the financial pressures of the 2020s both inevitable and structurally very hard to escape. Governments carrying $27 trillion in debt could not easily cut spending because the social and political costs of austerity measures were simply too high. Central banks could not easily lower rates again because inflation was still running above their stated targets in multiple major economies around the world. The financial world found itself caught between two dangers: inflation created by too much money and debt built by too many years of cheap borrowing. This is the trap that the 2008 solution constructed quietly over 15 years, while markets celebrated and politicians declared that history had been overcome. The people who rescued the global economy from immediate collapse in 2008 were not wrong to act, and their decisions prevented enormous immediate suffering. But every powerful solution carries embedded consequences that only time and changing circumstances eventually reveal in their full and undeniable form to the world. By 2023, the Federal Reserve had raised interest rates 11 times in a row, a pace of tightening not seen since the Volcker era of 1981. Paul Volcker had stood before the Federal Reserve Building in Washington, D.C. in 1981 and raised rates above 20% to kill runaway inflation. That decision in 1981 caused a brutal recession, pushed unemployment above 10%, and sent factory workers across the American Midwest into serious hardship. But Volcker succeeded, and inflation fell from 14% in 1980 down to 3% by 1983, restoring confidence in the United States dollar. The Federal Reserve in 2022 was attempting the same difficult maneuver, but the conditions underneath the economy had changed enormously since that earlier era. In 1981, the United States federal debt was approximately $1 trillion, a figure that made aggressive rate hikes painful but ultimately survivable. By 2022, that same debt stood at over $30 trillion, meaning every single percentage point rise in interest rates cost the government billions more. The Congressional Budget Office in Washington, D.C. projected that interest payments on the national debt would exceed $1 trillion annually by 2025. A nation spending $1 trillion every year simply to service existing debt has far less money available for schools, roads, and healthcare programs. This was the quiet and growing consequence of 15 years of cheap borrowing. A debt load so large that higher rates became genuinely dangerous. Meanwhile, across the Atlantic Ocean, European governments that had also borrowed heavily during the low-rate era were facing the same mounting pressure. The European Central Bank headquarters in Frankfurt, Germany raised its benchmark interest rate from negative 0.5% to over 4% in just 18 months. Negative interest rates had existed in Europe for years, meaning banks were essentially paying the European Central Bank to hold their money safely. That extraordinary policy had pushed European investors out of safe bonds and into riskier assets in a desperate search for any meaningful financial return. When rates reversed and climbed sharply, those same investors holding riskier assets began seeing significant losses accumulate on their balance sheets simultaneously. In Japan, the Bank of Japan building in Tokyo had held rates near zero for so long that the country became the world's largest creditor nation. Japanese investors had borrowed cheaply at home and placed those funds into higher-yielding assets in the United States and across Europe for years. This strategy, known as the carry trade, had quietly moved trillions of dollars of Japanese money into global financial markets over many decades. When the Bank of Japan finally began raising rates in 2024, those carry trade positions began unwinding rapidly and sent tremors through markets worldwide. The unwinding of Japanese carry trade positions in August 2024 caused one of the sharpest single-day drops in global stock markets seen in years. The Nikkei stock index in Tokyo fell by 12% in a single trading session, a drop that sent visible alarm through trading floors everywhere. This was not a random event, but a direct consequence of the interconnected low-rate architecture that had been constructed carefully since 2008. Every thread pulled on one part of the global financial system sent vibrations through every other part because everything had been woven so tightly together. Back in the United States, the commercial real estate market was quietly becoming one of the most closely watched vulnerabilities in the entire financial system. Office buildings across San Francisco, New York City, and Chicago sat partially empty as remote working habits established during the pandemic refused to reverse. Vacancy rates in major American city office districts climbed above 20% in some areas, levels not seen since the deep recession of the 1990s. Banks that had issued mortgages on those office buildings during the low-rate era were now holding loans against properties worth significantly less than before. The total value of commercial real estate loans held by American banks was estimated at over $2.7 trillion, a number that demanded serious attention. Regional and community banks held a disproportionately large share of those commercial real estate loans compared to the largest national banking institutions. This created a quiet but serious vulnerability inside the banking system, concentrated in institutions that lacked the size or resources to absorb large losses. The Federal Deposit Insurance Corporation, headquartered in Washington, D.C., began quietly monitoring hundreds of smaller banks for signs of growing financial stress. This was the direct inheritance of the 2008 solution, a financial system so dependent on cheap money that returning to normal rates created structural cracks. The architects of the 2008 rescue had not intended to create these problems, but intentions and outcomes are not always the same thing in economics. Across the broader American economy, households were also beginning to feel the sustained pressure of higher borrowing costs in their everyday financial decisions. The average interest rate on a 30-year fixed mortgage in the United States rose from approximately 3% in 2021 to above 7% by 2023. A family buying a median-priced American home in 2023 faced monthly mortgage payments, roughly double what the same purchase would have cost in 2021. First-time buyers standing outside real estate offices across suburban America found themselves either priced out entirely or stretching their finances to the limit. Credit card interest rates in the United States climbed above 20% on average by 2023, the highest levels ever recorded in modern consumer finance. American households were collectively carrying over $1 trillion in credit card debt by the end of 2023, a record high that drew serious concern. Auto loan delinquencies began rising steadily as monthly car payments that seemed manageable at near zero rates became painful burdens. At higher financing costs, the consumer spending that had powered the American economy through the post-pandemic recovery was beginning to show the first real signs of serious strain. Retail stores across American shopping malls began reporting slower foot traffic as households facing higher debt payments reduced their discretionary spending, noticeably the economic model that had worked during the zero-rate era. borrow freely and spend confidently was no longer functioning in the same reliable way. And yet inflation, despite all the rate increases, proved frustratingly stubborn in certain categories and refused to fall as quickly as policymakers had expected. Housing costs, medical services, and insurance premiums continued rising even as goods prices stabilized, keeping the overall inflation index elevated above target levels. The Federal Reserve was facing a classic policy trap, where every available action carried serious risks, pointing in multiple and sometimes opposing directions. Raising rates further risked fracturing the commercial real estate market, straining regional banks, and pushing the broader economy toward a recession nobody wanted. Cutting rates too soon risked reigniting inflation just as it was finally beginning to cool, destroying the credibility built through 2 years of painful tightening. Federal Reserve Chair Jerome Powell stood before cameras at the Federal Reserve Building in Washington, D.C., and acknowledged the genuine difficulty of the situation. The language used by central bankers at press conferences in Washington, D.C. and Frankfurt became the most carefully studied text in global financial markets. Every word choice, every pause, and every change in phrasing was examined by thousands of traders in dealing rooms from New York to Hong Kong. This was the world that 15 years of quantitative easing had created, one where markets had grown completely dependent on central bank signaling. The real economy of factories, farms, warehouses, and workshops had become secondary in many ways to the financial economy of rates, bonds, and expectations. This inversion, where financial conditions mattered more than productive output, was itself one of the defining and troubling legacies of the choices made in 2008. In 2024, the United States government was borrowing approximately $2 trillion every single year, just to cover the gap between spending and tax revenue. That borrowing was happening at interest rates of 4 to 5%, rather than the near-zero rates that had once made large deficits feel manageable. The interest payment alone on the national debt crossed $1 trillion in fiscal year 2024, surpassing the entire defense budget for the first time in history. For context, the United States was spending more on interest for past borrowing than on the entire military establishment. A striking and sobering comparison. This structural shift was quietly documented in budget tables inside government buildings in Washington, D.C., without receiving the widespread public attention it deserved. Foreign governments that had long held United States Treasury bonds as safe reserve assets began diversifying their holdings more aggressively than in previous decades. China reduced its holdings of United States Treasury bonds from a peak of $1.3 trillion in 2013 to under $800 billion by 2023. This was a slow but steady withdrawal from the system that had funded American borrowing for decades, a signal that quiet shifts were underway globally. The dollar remained the dominant global reserve currency, but its share of international reserves had declined measurably from 71% in 2002, about 58%. Every percentage point decline in dollar reserve status represented a reduction in the unique financial advantage the United States had enjoyed since the Bretton Woods era. That advantage, sometimes called exorbitant privilege, had allowed the United States to run large deficits without the currency crises that would cripple other nations. If that privilege continued to erode, the cost of financing American debt would rise even further, creating a feedback loop of borrowing costs and growing deficits. The generation entering the workforce in 2024 and 2025 was inheriting an economy shaped entirely by decisions made before many of them were adults. Young workers stepping into offices and warehouses across America faced student debt, high rents, expensive mortgages, and a government already carrying enormous debt loads. The assets accumulated by older generations through the long bull market, powered by quantitative easing, were not easily accessible to those who arrived much later. Wealth concentration data from the Federal Reserve showed that the top 1% of American households held more national wealth in 2023 than at any prior point. The bottom 50% of American households collectively owned roughly 2.5% of total national wealth, a share that had barely shifted in 20 years. These numbers were not the result of malice, but the predictable, mathematical outcome of a policy that inflated asset prices for over a decade consistently. The 2008 solution had saved the financial system that existed in 2008, and in doing so had preserved and amplified the inequalities already embedded within it. By 2025, Every major institution, from central banks to government treasuries to international financial organizations, was grappling with the same fundamental set of challenges. How do you reduce government debt without cutting services or raising taxes in ways that trigger immediate and severe political and social disruption everywhere? How do you lower inflation without raising rates so high that you cause a financial crisis among banks and borrowers built entirely on cheap money? How do you restore economic opportunity for younger generations without deflating the asset values that older generations depend on for retirement and financial security? These questions have no easy answers and no painless solutions, which is precisely what makes the situation in 2025 and 2026 genuinely and historically significant. The International Monetary Fund headquarters in Washington, D.C. issued multiple reports between 2022 and 2025, warning about the risks of high debt in a high-rate world. The Bank for International Settlements in Basel, Switzerland, sometimes called the Central Bank of Central Banks, flagged the same structural vulnerabilities in its annual reports. The warnings were heard, acknowledged in speeches and policy documents, and then largely set aside because the political costs of action remained far too high. History shows repeatedly that financial systems rarely reform themselves voluntarily until a crisis forces the change that comfortable times consistently and predictably postpone. The 2008 crisis forced a change, and the solution to that crisis is now creating the conditions for the next forced reckoning the world must face. This is not a prophecy or a prediction, but simply the observable pattern of cause and consequence recorded across centuries of documented financial history. The same pattern appeared before the Panic of 1873, before the Great Depression of 1929, and before the savings and loan crisis of the 1980s. Each time a solution was applied and a system was rescued. The rescue itself created new dependencies and new vulnerabilities that took years to fully mature. The world does not move in straight lines, but in cycles, and understanding those cycles is the beginning of genuine financial literacy for any serious observer. What comes next is not yet written, because the decisions being made today inside government buildings and central bank boardrooms will ultimately shape that outcome. But the shape of the trap is visible. The forces pressing against it are documented and real. And history asks us simply to understand that clearly, the past still has stories to tell. Subscribe, and let us uncover them together.